It's official, we are live. Great. Finally, my own fault, human error. Once again, thank you for your patience. Let's get straight into it. So, if you are looking for swing trading daily, weekly or monthly swings, or to profit from daily, weekly or monthly swings in any of the financial markets, as we keep saying, the longer we keep doing this, the more I'm validating the strategy across multiple timeframes, multiple markets. Pretty much there is something for everyone wherever you are in the world, and it's interesting because I have traded most things around the world, starting off with Forex futures, European, US. Predominantly I trade stocks, ETFs, and via stock options these days. So there's nothing that this doesn't work on, and at the click of a button, which we'll see later, we get to validate, is this the right market, the right time frame, the right strategy? You put those three things together, bish bash bosh, we make some dosh. So if you want to be the right place, then we're here. You are in the right place. If you're looking for underwater basket weaving, then perhaps not. Maybe you click onto somewhere else. My ultimate objective with these open sessions is to show you that trading should be simple. I've made it complex. I've done the Dow 3, GAN 3, Elliott wave theory. I've done the complex mathematical formula. I've sat down with calculus and abacus and other things that end with us. And I always come back to it being full circle, simple. And you don't need to make this complex. It doesn't have to be, it doesn't need to be. And I'm going to show that to you in a moment. My goal with these sessions, as I mentioned, is to make it accessible, to give you the tools, the rules, the software to assist you, provide this community to support you. And because the coffee's kicked in, it's a hyperactive mentor today to show you the right way. I've had far too many coffees and it has kicked in. And the bottom line is we need to get results that we can. It needs to be replicatable. Again, I get my results, my students get their results, but ultimately we get results together. And there's so many systems out there, and this is one of the motivations for starting, helping and educating and mentoring students all the way back, starting in 2001, 2002, is because it wasn't replicatable, and that really is the bottom line. Most people have some sort of system, and a lot of it's discretionary. And it works for them, but when you try to apply it, you're not getting the results. So there's some missing ingredients. And so my mission really over the last 20 years is firstly make it simple for me. I want to be able to check in, check for trades and check out. And that means that I need a more algorithmic type of approach, a systematic approach to find, filter and sort opportunities so that I can go click, click, pick, trade, and then bugger off and go and do something else. I like to spend as little time as possible at the computer these days, which opens up the opportunity for me to do these open house sessions and help other traders get their own measure of success. One of the things that we want to try and achieve is to put definition on what we're doing. So many people buy the dip, and you hear it all the time, buy the dip, sell the rally. And they don't qualify or quantify what that actually means. So what we're going to do is put some meat next to the potatoes, with a bit of gravy and a blob of veg. I don't know where the food metaphor came from; it just came to me. But we're going to put some substance to the BTFD, the buy the in dip. We need to just add a qualifier in the context of a trend. And then suddenly it starts to make sense. A dip in the context of a trend, buying value in the context of an undervalued, if we were Warren Buffett, we want to buy good companies at a discount. It's a different way of saying the same thing, but with a different time horizon. I'm a chartist, so I'm going to use a visual representation of a trend and look for a point that I consider that stock or trade idea to be at a discount. And that's what a dip in the context of a trend is, a value proposition for that particular trending opportunity. Now, before we get into it, I do have a teeny tiny talking point related to this. So if you don't mind me stepping on my soapbox and attempting the Financial Fridays equivalent of the Friends, Roman Countryman speech, I'll spend just 2 or 3 minutes doing this, and then we can hit the charts hard because there's some interesting things. I've already touched on this previously, but I've come across this several times recently and I'm reminded of it again. And really, do we want to look smart as a trader, or do we want to trade smart? It sounds like there's not much difference between them, but there's a huge difference. To be looking smart on one trade, have one trade idea that is right so that you can thump your chest and bang your ego and say, look how great I am. That's looking smart. But if you're trading smart, you're putting that ego in check. So that's what we just want to discuss just for a few minutes today, if you'll indulge me, because I feel it's very important, because I'm reminded of this several times in several different places this week. So we have two choices. As we've already said, do you want to look clever while trading, or do you want to make money consistency from swings in the financial markets? And again, as always, just adding a layer of definition on the 2 points. Do we want to look clever, or do we want to make money? I think I would rather make money and not worry about looking good while trading. Again, being right. Again, because I don't have to be right. And the first thing to consistent success over the long term, multiple decades, I'm almost in my third decade of studying and trading and watching the financial markets. And one of the contributing factors is not having to be right. And what I mean by that is I've dropped the ego and I'm trying not to be right every time. Now, when I first started out, like everyone, I wanted to be right on every trade, every day, all of the time. And eventually you only need to be right on average. And it's a subtle distinction, but when you drop the ego of trying to be right on every trade decision and you apply standard business practices, again, whether you own a business, most of us have worked for a business or do work for a business, and we're not looking to be right every day with every decision. And we're going to make some good decisions, we're going to make some bad decisions, but on average, we're progressing the business forward. On average, at the end of the day, the week, the month, the quarter, the year, we've got an on average return on investment, return on capital, return on insert the metric. So we only need to be right on average consistently. And when I first started doing this, when I had this realization, I stopped worrying about being right. And it was almost tied to position size. There's a few things that are interwoven to this, the ability to drop the ego. And part of it's position size, because if you've got too big a position size on your individual trades, then you're kind of like, I hope this is right. I hope I'm not wrong. You have that experience, and then you start having the need to be right because your position size is too big, because you want to win big. And trade small, it reduces the need to be right, and then you can let go of the ego to wanting to be right. That opens the ability to look for this on average profits. And it's the, comparable to the tortoise and the hare. Anyone can be right big once, but it's being right small and regular and consistent that's going to win this race. So be the tortoise and not the hare. And the other thing that we need to consider is we don't need to reinvent the wheel. I've discovered the wheel. It's great to discover the wheel. And I've discovered the wheel, AKA the strategy, multiple strategies, many, many times. But the reality is it's already been invented. And again, I'm not going to lie. It's wonderful when you discover something, an edge, an opportunity in the markets. And we talk about these, and we talked about several last week. One of my recent discoveries is almost a sentiment timing for when the market is overextended one way or the other. And it's not new. It's been around for a long, long time. But I had a realization that actually this is useful and I can integrate it into what I'm already doing. So it's not that we need to reinvent the wheel. A lot of it's already been discovered, but the hard part is because there's so much that actually works out there. The difficulty is that everything works some of the time, but nothing works all of the time. So a large part of it is trying to figure out what works for you, for your business of trading. Again, comparable to the real world of business. It's like trying to figure out, well, what business do I want? Do I want an online business? Do I want a local business? Do I want to be a multinational conglomerate? Do I want to have physical products, digital products? Do I want to be a manufacturer? You see where I'm going with this? You have the same issues in the real world of business. So what we need to do is just pick one thing in the trading world. When I started out, far too many years ago now, I was drawn to geometric shapes and patterns, the consolidation patterns, the head and shoulders patterns, the triangles, the wedges, the fractal patterns, the wolf wave. I was interested in those things. I was interested in geometry. I'm a very visual trader. So that was what I was drawn to, and fast forward these days, I've grown, I've evolved. I'm trying to remove discretion in my trading because I don't like second guessing my own decisions. So I want this for me first. And that, for the last sort of 15 plus years, nudged me further down the track of algorithmic approaches. So where we've ended up today is rules. I need rules. Rules are bloody boring. If this, then that. And these days, I now refer to what I do as a production line. When ABC has happened, take, X, Y, Z action. It's boring, and it should be boring. But guess what? Boring makes money. Boring prevents me from being the stock market equivalent, or doing the stock market equivalent as Where's Wally, flicking through chart after chart like mindless zombie, spending hours and hours and hours, adding indicator stacking, time frame hopping, market hopping, and just jumping from one thing to another. Again, let's compare this to the real world of business. Let's say that you decide to, on a Monday, you're going to sell fidget spinners and no one comes in and buys any. So, Tuesday you decide to, I'm going to flip sneakers. I'm going to, buy trainers or sneakers and flip them. And then that doesn't work out. So on Wednesday, you decide to go online and you start doing stuff on eBay. You're going to buy beanie bears on eBay, but because you read somewhere in the 90s that was a good thing to do. And lo and behold, it doesn't work. You're jumping around. And if you did that in the real world of business, everyone would have an opinion on why it's not working for you. You are dicking around like an idiot. Pick one thing and focus on one thing until success. So in the trading world, people do that and don't think twice about doing it and wonder why it's not working. So the bottom line is if you ever find yourself asking, where's the trade? You've not got the right indicator, the right time frame, the right market. And more importantly, you've not got a systematic approach to find your opportunities. So if you ever ask yourself, where's the trade? You need to keep asking yourself and defining what it is you're doing. So for example, I want to buy the dip in the context of a trend. That's my number one money-making pattern. I've got 6 of them. My number one money-making pattern, it's the most mechanical thing that I can do to make money. Buy the dip in the context of a trend. Great. Now I need to define what I consider a bullish trend. Then I need to define what I consider to be a dip, and then a dip worth buying. We're going to look at that in just a moment. But what it means is it transforms the where's the trade experience with our random guy on a bench stroking his photoshopped beard into there's the trade, there's the trade. That's what I want. I want to be able to check in, check the trade, and check out. We're going to look at that in a moment. And that's what rules allow me to do. And those rules, rather than I segue, are right here. There's 4 of them. The average price, the 50 period moving average needs to be crossed above the 200. That's going to give me a bullish direction. To help me with false starts and whipsaws, I'm going to wait 20 days or 20 bars if you're on a different time frame. That helps me avoid the false starts. That is, at that point, a bullish trend. From that point onwards, I'm looking for a Bible dip. So when price comes below, in this example, just for simplicity, the 50 period moving average, I'm going to say that is now a dip, a buyable dip. When it goes back above, it becomes a dip worth buying, and I'm going to buy it, and I'm going to profit from the acceleration away from the moving averages. So for example, at this point, we've got a Bible dip. We're going to profit from the away movements. Bible dip, profit from the away movements. Bible dip, profit from the away movements. Bible dip, profit from the away. But you see where we're going with this? That's what we're trying to achieve. Bible dips. And just the opposite is sellable rallies. And that's what we're going to do. We're going to look at these things in more detail. I've covered these rules in a lot of detail in the past. But bottom line is it stops me from wondering where the trade is. It stops me from flicking through chart after chart like a mindless zombie, hoping that the next one is the one, and wasting time, money, effort, energy. Years can go by and you can do this. I've known people that have been doing this for 20 years trying to make this work. And all we want to do is change the question. Instead of saying, where's the trade? Know what you're looking for. I know I'm looking for a Bible dip in the context of a trend. That means that I can go, oh, there it is right there. There's the trade, put the trade on, walk away. So this is what I do. It's production line trading. We've got a wonderful family, strategy family. We've got the ability to profit at the end of the month and the quarter using the daily charts with this system. We've got a short-term swing trade on the lower time frames that has an average payout cycle of 7 to 10 days. We've got a one trade a day strategy for the S&P 500. I'm researching the use of this on the DAX because I know we've got one or two European traders here. It also works on currencies, Forex, real currency, not that fake shit. We've got we've got the ability to profit in the morning at the open to capture the main move of the morning. Can we see a theme here? We're looking to capture the main swing of the morning, the day, the week, the month, and the quarter. We can also profit from range trading. There's a little bit of discretion required, but we again have a rule-based checklist that allows us to scan for these opportunities. And it's all validated and time-tested and back-tested and forward-tested and real-tested. I've placed quite literally thousands of trades with this system, but we've also got the historical data to support that it's not just something that Phil is good at, it's something that's replicatable. Right, that's my soapbox done, folks. That was my just little Mr. Ranty Pants about looking smart or trading smart. I want to trade smart. I'm not bothered about being clever anymore. We all transition from wanting to be right every time to now I just want to be right on average. So no more Mr. Clever Clogs, drop the ego and let's all make some money. So who is this guy? My name's Phil Newton, in case you are brand new to these sessions. Hello, if you are. We've got this live streaming on the YouTube. So if you're on the YouTube, you're watching this live, I can see you lurking there, Mr. Viewer. Pop a hello in the chat box. If you're with us on Zoom, let me know if you've got any questions, comments, observations. So as I see them, I will get to them. I'm just a regular guy. I like cake, coffee, walk, flamingos. My days are very relaxed. But ultimately, you should not listen to me. I am not a Wall Street guru. I am not a financial advisor. Nothing I say should be mistaken with financial advice. I've got to say that legally. Past performance is no guarantee of future performance. However, I can show you that the trades, the charts, the markets, the opportunities, they do sing from the same song sheet. And again, that's what I can demonstrate. I've spent the last 30 years dedicating my life to making it work for me. And as a byproduct of that, it means that it works for you. Again, I'm just a regular guy. I never had anyone to ask when I first started out, and that's why I like to do these sessions. And I am the type of guy that likes to stop tourists to see if they need directions. Some people are like that, and unfortunately, or fortunately for you, I am one of those people. So I will be in your corner as a mentor. And did I mention I like flamingos? And we've all got a strange thing. I've got a quirk for them, but who cares? It's my thing. It's my party. I can do what I want. Anyway, bottom line is we get results. I get results, my own results. And my students get results as well in up and down markets. Some recent results from the last week, week or two actually. We've got AMD stock, and we've got the S&P futures strategy is rocking and a rolling. A little bit of a false start again. We're not all big winners. There's only 6 points there, but then the following day it produces a monster. I was posting these in real time on the socials and in my group. So if you're not in the Slack group or the Facebook group, then you're missing out on some real-time alerts. We also just closed, when I say we, it's the royal we, aka me. Broke statements on the chart there. Google, we've been following this for the last several weeks in real time. So again, there should be no surprises that the trade's done what we thought it was going to do. And lastly, before we hit the charts proper, there is a commercial intent warning. You can work more closely with me. It's an invitation. It's by choice. Only you know if what I do is the right thing for you. At the very least, I'll always point you off in the right direction because, again, I appreciate that what I do is not right for everyone and isn't right for everyone, and I don't work with everyone. But if you want to talk about it, we can do. There's some information on my website that will outline the types of things that we do. I'm obviously showing you in real time what I'm doing as I'm doing it, so you can see if it is the right thing for you. And if it is, and you want to learn the specific rules, because I'm only giving you the back of the envelope version for speed on these sessions, but you can work more closely with me. Just remember, though, if you change nothing, nothing will change. One of the things that I strove to do early on in my trading career, when I was trying to figure it out alone, I did it the hard way, was, okay, if I had a negative experience, meaning that I had a bad experience trading, I had plenty of profitable trades that were negatively experienced. So I could make money and still feel shit about it, is the point. What I was trying to do was, like, how can I either repeat that success or prevent it from happening? So if you keep doing the same thing over and over again, you're going to continue to get the same results. And a lot of people try to apply theory, and the clue's in the name there, theory. theoretical nonsense that was written in the 1950s that has no substance other than the author's viewpoints. A lot of the patterns that we have today, they're all recognizable patterns, but as we've said previously, they don't typically work the way that you think they're going to work. What I would rather do is recognize that a thing, an event, a pattern, a sequence of events has happened. What is the most common thing to happen afterwards? So my own training started to quite revolutionarily change when I stopped thinking about what the textbooks was telling me to do and just recognized that there's an opportunity here. And what most commonly happens afterwards? Okay, great. It's probably going to be very different from the textbooks. So just have an open mind and don't be biased into the author's narrative. And I would say that for even my stuff. I'm going to show you what I do. I'll prove that it works for me. I know that it's replicatable because my students tell me it's replicatable. As we see here, we've got plenty of success stories. But just keep that in mind. If you don't want to work with me, just have that viewpoint for your own trading. Make minor adjustments and course corrections along the way, and you'll start to see incremental change. You've only got to be 1% better every day, and you'll be 1,000% better at the end of a decade. So lastly, two choices, just while we're on the soapbox of these things. There's an old way. The old way is what most people do. You can flap around and try and Frankenstein a profitable trading system together before it's too late to make a real difference for your trading. Again, doing that Where's Wally experience. Or you can press the easy button and plug into a system. I don't care whether it's my system or someone else's system. I honestly don't care one way or the other. I do what I do, and I'm going to carry on doing it. I love helping and trading and teaching people, but I would urge everyone to find a mechanical algorithmic system, something that is not subjective in nature. So if you are looking for a mentor to guide you down the road, have that as a qualifier. Is it a mechanical rule-based trading system? If the answer is yes, then you can probably replicate it. If it's discretionary, and there's plenty of discretionary opinionated systems out there, but they're often not replicatable because it requires judgments, and your judgment's different from my judgment, different from the next person's judgment. So this is the two choices. You can carry on flapping around, or you can find a rule-based system. Mine, I've been developing it for the last 28 years. I've invested a cat's whisker over $34,000 having it coded. It's continually being updated and tinkered and tweaked with. So that number will get bigger. And right now, the system manages quite literally millions of dollars in the financial markets around the world. It's the same system that I used to manage my own hedge funds when I was more actively involved in that side of the business. Results, we've already been through the results, blah, 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 blah. So the agenda, we're already mostly through the agenda, the good news. The session's going to last about 60 minutes. We're about 20 minutes in. We've introduced myself. I've said hello to all the new people. So who have we got in the room today? Everyone's logging in. Adrian, Al, Brett, hello. Shando, hopefully I'm pronouncing your name right. Chris, David, Glenn, hello. Jack, James, John, Mark, Perry, hello. Randy, you're not my friend. Rick, Rodrigo, Ronald. Hello, Steve. It's been a while. Vito and Zeke. So we're going to got a nice full house, some new names, some old names. Hello and welcome. We're going to take a look at the markets. I talk super fast. I'm just a regular guy from a funny place called Liverpool in the UK. You may have heard of it. It's where we sprouted the Beatles. There was a huge phenomenon with them. You may or may not have heard them, but that's where the funny accent comes from. I do talk fast. I think fast. That just means you need to think faster to keep up with me. Again, it is recorded, so if you're watching this on the replay, you can just crank the slow down button and watch it a little bit more of an acceptable pace. We're trying something new, as we said last week. Glenn, this is your fault. You best hop on the call today. The phone lines are open. If you'd like to hop on, and I can open the mic if you've got questions, if you've got a view on the news, if you've got, again, questions, if you've got a big takeaway, feel free to hop on the mic and we can have a little bit of a chat about the markets. And with that said, let's go chase some squirrels and nerd out on some charts. Zinger. Right, there we go. Let's do it. Right, let's start off with one of the things that I always talk in is it the second or the third person? The royal we. It's like the Queen, isn't it? My husband and I. We as in collectively, you, me, and DP. started to introduce this sentiment indicator. And this is what I mentioned earlier. It's not new. It's nothing revolutionary. There's nothing customizable from an algorithmic approach. All this tool is, it's the number of stocks that are above or below the 20-period moving average. And one of the things that we did just a few weeks ago, and this was motivated by a question from the group probably about 3 or 4 weeks ago now. And I'll say, I can't remember what the question was, but it was, we can go and look at the number of stocks that are past the 20-period moving average. And as a throwaway comment, yes, sometimes I'll look at it and you can see when a market is overextended. I'm not saying overbought or oversold, but you can see when it is overextended. And it's almost uncanny when you say that it's overextended to the upper side. So when we have a reading of 80 to 90%, so what that means is the number of stocks in the S&P 500, 80 to 90% of them are above the 20-period moving average. Now, in and of itself, that's just a statistic, but the whole market is participating in a rally, and that could suggest an extension of the movement. But what we can see, as I'm just marking off some of these points, when we have these extremes, it has typically led to some downward movements in the market, some downward movements in the market, some downward movements in the market. And it shouldn't be a surprise to anyone that this is a consistent, repeatable observation. It's not quite mechanical, but there's a very clear, we are overextended. You're right here. We are overextended. Right, what can we anticipate in the next 3 to 5 days? We can start to see the exhaustion of the upward movement and the start of the next downward movement. And it's uncannily accurate within about 3 to 5 days when we have these overextensions. Again, I'm just scrolling back through the last 2, 3, 4, 5 years. It's a regular observation. So what I can do is I can use this to anticipate market movements. And again, just last week, was it last week? No, the week before, my apologies. Just last week, we have this overextended to the downside. I'm trying to be intentional by not saying it's oversold, because it's not. There's no such thing as overbought or oversold, but there is an extreme movement, extreme reading. The market is extended to the bear side, meaning that 90% of the stocks on the S&P 500 are below their 20-period moving average. They're moving lower. So there's an anticipation that there could be a bullish movement, a bullish reaction, which is what we saw on that part of the chart there. And if you remember, we planned a trade for the breakout of a descending channel on the lower timeframes. So we use that information to start looking aggressively for trading opportunities. Then conversely, we can see that price is moving back lower again. We're resuming the downward movement. So we have this opportunity to essentially time the market. Let me just zoom out actually, and we can go and take a look at that trade that we were just talking about. So we have this. So this is what we were just talking about. So you've got that over here. We have the overextended reading to the downside based off the dailies. We've got this descending channel. So we've got price breaking out. So it should be no surprise that we saw that rally, because we're anticipating a rally. And then when you combine it with a pattern breakout, prices above the 200, it breaks out of the descending channel that we'd identified at the time. Again, we did this in real time in these open sessions. So there should be no surprise that we can time these markets. Now we're back below the 200-period moving average again. We've got to be back bearish, which is the general philosophy of using the over-under rule for moving averages. So moving average, again, the average price has crossed over. There's the 200, there's the 50. We've already said that when that happens, I've got to be bearish. We're back inside the prior consolidation. And again, what we were looking for is selling the rallies in a downtrend. So we've got a nice downtrend. I'm looking to sell the next rally. Might not get it today in fairness, but as price continues on these lower timeframes, this helps me find these one trade a day type setups. And then with the sentiments that we've just been through, it allows me to be more aggressive on the bullish or the bearish side, take advantage of what could be an extreme movement or extreme reaction in the markets. Thinking about the markets, look at FedEx. This is This is, wow, look at this. This is amazing. So we've got trade on here. We've got the algos trade on there. Again, when prices passed all three moving averages to the downside, we should be bearish. We've had multiple opportunities all this year, despite the market being, to be fair, quite shitty. But it's moving quite nicely. Again, one thing that I just want to highlight, this is just highlighting why I trade the way I trade, meaning that I typically use a stock option as an alternative to trading stocks. Let me just zoom in. So I typically trade a stock option as an alternative to trading stock. And we went through this again in real time. I call most of my trades out in real time, win, lose, or draw. But this is why I use the full price of the premium. So if I've got a $5 option, every option controls 100 shares. So my risk is fixed at $500 per contract. Again, I'm just making the number up for simplicity. Okay, Glenn, I've got your account there. We can hop on the mic and we can sort it out. So if I've got a $5 option, so $5 per share, every option controls 100 shares, and I place my trade here. Okay, the algo, you can just about see there, the algo is using stock, in fairness, because I've got to tell it to do something, and it's just a ball to code up the option stuff. So the algo is being stopped out. Technically, that's a monetary loss. It's just part and parcel of the system and the process. It's also technically being stopped out there. Now, I'd already taken the profitable trade, so that my new trade is right here. So why? Prices below all three moving averages, go short. Great, that's what I'm looking for. Now, in this case, initially, at the beginning of July, it didn't work out. It didn't work out for July. It didn't work out for all of August. We're now in September. But what I'm not doing is using a stop loss in the traditional sense. I'm not closing my trade prematurely, unnecessarily, because my risk is already fixed with the full price to premium. Let me say that again. My risk is fixed to the full price to premium. So I don't need a traditional stop loss. So this can be wrong over time. It could be wrong deeply as it goes just in the opposite direction. There is no benefit to closing the trade early. I might as well take it all the way to expiration to see if I can manage it better. And this is a good example of the other way, where this happens often enough, where there's no benefit to closing the trade. I might as well take it to expiry. I've still got about 100 days left on this trade, but I've got the opportunity to manage it better. So this trade, my objective was, you know, it's coming back in my favor. It's around about break even. I've still got enough time to see if it's going to work out. And maybe if it moves, you know, below $200, I probably would have closed it for a break even trade and looked to reposition myself. And then this happens. This happens often enough to take the trade to expiration and to not worry about a stop loss in the traditional sense. So I would urge everyone to consider a stock option as an alternative to trading stock. For this reason, it allows us to manage the trade more effectively when an opportunity arises, to manage it more effectively. Thinking about it on the other side, again, I've regaled you of the Apple trade from earlier this year. Why is this not working? AAPL, let's go. There we go. So I've regaled you of this trade as well. This similarly happened earlier in the year. Now, obviously, viewpoints have changed, but at this point here, right there, buy the dip, prices above all three moving averages. At this point, again, we obviously know what happened with hindsight, but that got me in the trade there. I didn't know that that was going to happen, but at this point, there's no benefit to closing the trade. But we get this lovely market rally, and then back here, I can close this trade for a small profit and then look to reinitiate on the next pullback. Now, the next push and pullback was there. It never gave me the new entry, but this is part of the system that we can use. This is just another benefit of managing the trade more effectively with enough time to consider. So there's no benefit to closing the trade on a stop loss. So if we reduce the number of losses that we have, then the system and the strategy that you're using becomes even more efficient. So let me just demonstrate that to you visually. So this is why I'm doing it. But if we look at the equity curve, so this is the equity curve. If I just buy the dip, sell, the rise, when prices above all three moving averages go long, when it's below them, go short, and it's most mechanical with no subjectivity. If I just did that, we've got a lovely steady equity curve. Now, because I'm avoiding the multiple stop outs, I'm still, when there's going to be a loss, there'll be a loss. There'll always be a loss when you're wrong. But I'm reducing the number of losses from, say, 3 to 1, because there's 1, 2, I think there's 3 losses. There's 3 losses in the background there. So I'm not taking 3 losses. I'm only taking the 1. And that 1, I've got the chance to get a break-even trade, which is what I'm talking about. So this equity curve should be even smoother just by simply changing the vehicle that we trade with. We go from stock to a stock option and use an option as an alternative to stock. You get this smoother equity curve. So that, again, there's lots of benefits to doing this. The other benefit of using this stocks and stock options rather is we get then to trade a portfolio because it's not capital intensive. What do you mean by that, Phil? Why is it not capital intensive? Well, the rules changed in 2009 from if the price of the option, so again, coming back to our example, if the price of the option is $500, every option controls 100 shares, that means your risk for the option, your capital requirement and your risk is the same. It's $500. You can't lose more than $500. And with a margin account, it's not going to cost you any more than $500. Just let that sink in. It's not, you don't have to have the margin requirement for the underlying stock, which could be several $1,000s for 100 shares. Your risk is $500, your capital requirement is $500. That means that you can now trade a portfolio and start beating Wall Street at their own game, because the way that the banks, the hedge funds, the institutions operate and work and make money consistently, they're not trading one trade at a time. They're trading a portfolio of opportunities on a regular, weekly, monthly, quarterly, yearly basis. We can now compete with them at their own game with minimal capital allocation costs. And if you want to do it with a small account, you can do it with a debit spread. If you want to go down as low as $50 per trade, you can do it. If you want to leverage it up, then you can do as well. Again, you can use debit spreads. Again, just going back to your question, Glenn, get TradeStation software to set up. I have templates and tools. They're actually cloned inside the members area, Glenn, so you don't have to do it manually. You can quite literally download a copy of my TradeStation. So it's set up and looks exactly the same way. Sorry, there was just a little question about the TradeStation. Right, so let's get back to it. So S&P. We skipped ahead a little bit, didn't we? Sorry, I'm on a soapbox. The coffee's really kicked in today. At ES. I love this game. It's absolutely amazing. It's one of those, you know what, 28 years in, I've peaked and troughed with my enthusiasm for the markets, but I've got to admit, the last 8 or 9 years, my enthusiasm for what we're doing continues to accelerate. Glenn, what I'll do is I'll send you a copy of my desktop. It won't have the tools, the workplaces, but it'll have the toolbars and the layouts, and it'll all look similar, but you'll have to put your own workspaces and charts on, because obviously you don't have access to the algo and stuff yet, not yet being a member. Or if you want to wait till you're a member, I'll help you get it all set up anyway. Right, okay, so where are we? My enthusiasm for this just continues to grow. And I think also it's growing because I'm getting to, again, if you just think about it, there's the 20, the 50, and the 200. At its most basic, there's nothing magical about these indicators. I say this every week, there's nothing magical about this. But when price is above all 3 moving averages, go long, stay long. When it comes back between, take profits and look to reinitiate when it goes back above. That is at its most basic what we're doing. Just the opposite. When price is below all 3 moving averages, that's your profit potential. Guess what's happening right now? Guess what's happening? It's below all 3 moving averages. Go short. Benefit from downward movements in the market prices. And it is that simple. I mean, there's a bit more to it with, you know, precise entries, trigger bars, trade management. There's some targeting methodology built in there. Again, appreciate that this is an open house. It's Friday. It's the back of the envelope version. That's all you've got to do, you know. And I wish I'd realized this many years ago. And I think the other thing as well is you don't have, well, here's the magic button. We don't have to take my word for it. You don't have to take my word for it. If you just go long when it's above all 3 moving averages, go short when it's below all 3 moving averages, or take profits, then what we have here is there's the magic button that says if we just did that, We don't look at the Fed, we don't look at the news, we don't look at what's going on, we don't think about inflation, stagflation, other things ending in inflation. We don't have to worry about any of that. This is what a positive expectancy strategy looks like. If I just bought the dips and sold the rallies, as we've described many times in the past, this is what a positive expectancy strategy looks like. Now, it's also worth pointing out that this is non-compounded. This is just a fixed dollar amount in on every trade over the last 22 years. This is what a steady equity curve, a positive expectancy strategy, this is what an edge looks like in the markets. That's all you've got to do. It works. Have it with my love. Go and do it. And if you want help with it, if you want to get there faster, send me an email. We'll talk about it. And, I'll show you exactly the entries, the exits, the stops, the targets, how to calculate everything, how to do it manually if you don't have TradeStation. Oh, quick slurp. And we'll get you trading and making money in the fastest, smartest possible way. Anyway, so you don't have to take my word for it. Right, there we go. So portfolio trading. So the next part of this, as always, is, well, firstly, you can do it one at a time. Oh, look at that, glorious, absolutely glorious. If you can't gather from my enthusiasm, I'm short on about, I've got almost 100 stocks here. I'm short on about 60 of them. And it's just one of those days where I've been painfully, as you all know, I was painfully sat. Where's my drawing thing? I was painfully sat through that rally on the bear side of the market. And I didn't have a bullish trade setting up to save my life. And we spoke about almost jokingly and whimsically, but if there's nothing setting up, you can't trade what's not setting up. But now all of these trades are flipping over. So I've got to admit, I'm gleefully and joyfully rubbing my hands like old Fagin out of Oliver. So yeah, it's all going nicely. And just to put the cherry on the top of it, again, we've got FedEx. FedEx is coming back from let's try FDX, isn't it? There we go. FDX, come on, TradeStation, stop messing around. Look at that, FedEx coming back from the ashes. So again, this was probably a break-even trade. I was actually looking to close it as soon as I saw a break-even. It was just a little bit underwater, maybe $200 or $300 underwater. So probably was looking to close it, hopefully today, or just take it on the chin. So you can't. What's the saying? It ain't over till the fat lady sings. I think the fat lady's singing. I think I'm going to have a little bit of that when we finished here. Anyway, XXX. The chart is intentionally blank. So first part of this process, now you know the system. When the average prices are crossed up, the 50 and the 200, we are bullish. And when the 50 is below the 200, we are bearish. So over here on the left, that's what this column is doing. That trends column, this is just a customized version of what I've just shown you on the chart. I can see at a glance, these are all the bullish stocks. These are all the bearish stocks in my top 25 stocks. I'm going to have some of those positions are open. Some of them are going to be on the sidelines, and some of them are going to be on and underwater. There's going to be a mix is all I'm trying to say. But we can see straight away that there's the bullish trades, there's the bearish trades. So there's very few bullish trades in this top 25. And if you look at the tickers, you'll see most of them are in the energy sector. Unsurprisingly, they're in the energy sector. We can also see at a glance the 20-day rule. Are all of these stocks, or have they all been in the bullish or bearish posture for at least 20 days? So I can see, cast my eyes down, yes, they are. Great. So these are all of these 25 stocks have been in a trend for a sufficient amount of time to be active. Now I can look to buy dips and sell rallies. And again, remember, I'm looking for all the stocks that are above all three moving averages. So these three here, 1, 2, 3, 4. I can take shoes and socks off, filter count. 1, 2, 3. 1, 2, 3, 4. You can tell I'm just a poor farm boy, aren't you? You just figured a few things out. 1, 2, 3, 4. I can't even count up to 5 these days. There we go. 1, 2, 3, 4. All of those should be in a profitable posture because they're above all three moving averages. Does that make sense? So I can see at a glance, what, so I can quality control. Am I in SQM? Yes. Am I in LNG? I've got to admit, no, I'm not. CVX, yes. COP, yes, I am. And I don't need to be in ABC. It's in a bullish trend. You can see that there, but it's below all three moving averages. It's just about going to the other side. So I can just move that down the list. and pop that on, because it's probably going to change over from bullish to bearish. We'll find out, no doubt later on. In fact, I'm just going to park it down here actually. In fact, no, we won't. Just bear with me. I'll pop it as its own little islands. There we go. And the same thing with Allstate. Allstate is bearish, but price is above all three moving averages. So actually, let's put those two next to each other. So the point is, I don't need to look at those two stocks because they're not congruent with buyable dips or sellable rallies in a trend, because it's not meeting the definition of a buyable dip or a sellable rally. They are in a bearish and bullish trend as per the mechanical rule from the average price crossover, but price in relation to the moving averages is not where we want it to be. Does that make sense? Everyone happy? Let's go and take a look at it actually. Now, ABC, it's in a bearish, my apologies, it's in a bullish crossover. Oops, a daisy. It's in a bullish crossover. There we go. It's in a bullish crossover, but price is below all three moving averages. So I don't need to worry about a brand new trade on this. The algo has fired off, but I don't need to take a brand new trade on this. Same with Allstate. Price is in a bearish, oops, a daisy, pressing all the wrong buttons here, bear with me. Price is in a mechanical bearish trend, but it's below all three moving averages. Now we're looking at this chart. Oops, let me just squish it up. Now we're looking at this chart. We can see multiple crossovers in the average price. So why don't we just, as we've said several times previously, why don't we just draw a big box around it and wait for the breakouts? So one of the things that we can use moving averages for, which is not standard use for moving averages, is when we have multiple crosses in the average price, we can use that as an indication to say, you know what, price isn't trending. All of this year, price has been flipping and a flopping, and the average prices have been flopping and a flipping. So why don't we just draw a big box around it and call it consolidation? Wait for the breakouts. Cool. So now we've also got a rule to say when we don't use a moving average, because when the averages are flipping and flopping, they're not trending. And what we've got is predominantly a trend trading system. But now we've also got a means to find ranging patterns. So we draw a big box around it, and now we've got 4 other money-making patterns that we can trade. I can buy range lows, I can sell range highs, I can buy the break of range highs, or sell the break of range lows. So where is price now? It's in the middle. There's still nothing to do. So waiting for price to be at the optimal points for our 6 money-making patterns, primarily it's going to be trade the trend, buy the dip, sell the rallies. But when we have those multiple crossovers in the average price, and again, they're all relatively at the same point, around about this $125 mark on this stock. We've got multiple crosses in the average price. Maybe we just don't worry about it. It's non-trending. Great. When we've got at least 3 in the last 100 days, price is not trending. I've got to call it a consolidation. It doesn't matter what my viewpoint of the chart is. I don't need to recognize the name of the pattern. Just draw a big box around the whole messy shebang and call it a consolidation. By doing this, it means that you agree, I agree, Adrian agrees, Al agrees, Chris agrees, David, Glenn, John, we all agree it is in a consolidation. Let's not worry about the name of it. Who cares what it's called? But we're all in agreement that it's in a consolidation. And this means that it's replicatable. If I get knocked over by a bus tomorrow, God forbid, or maybe some of you are hoping, I don't know. If I get knocked over, the point is, if you never see me again tomorrow, you can replicate this tomorrow. And that makes it repeatable, replicatable, and profitable for each and every one of you. And obviously, there's a few more strategy-specific rules, but that's most basic. That's what we're doing. Buy the dip, sell the rally, buy the break of range lows, break of range highs, the reversal off the range low, the reversal off the range high. That's all you've got to do. Just wait for price to be doing one of those 6 things. Now, with that said, let's go and look at the charts. So now you know all the 6 money-making patterns. What's price doing here? Buy the dip. Oops, a daisy. Buy the dip in the context of a trend. Dip, trend. Waiting for the dip to buy a new rally or to profit from a new rally in a trend. Sorry, I'm just pressing the wrong button there. Let's check out CVX. Again, these are all in a bullish posture. We've got blue, 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 prices above all 3 moving averages. So what's price doing? It's in a trend, it's retracing, it's back above all 3 moving averages. and just waiting for it to profit from. Again, I'm in a trade here, just in the interest of disclosure. I got my slightly earlier entry. And if I can get out this at break even, that's my new objective. Again, they're not all profitable winners, but I've got an opportunity to manage the previous trade. When that's managed, I can look to take the next pullback and initiate a brand new trade and extend my duration. That's one of the objectives. But nonetheless, it's in a trend. Buy the dip in the context of a trend. The leave them alone, we've already established. Let's check out Apple. What do you think? Sell the rally. Well, to be fair, we've got the range marked off. There's the range high. There's the range low. Sloping. Reversal off the range high, below the 200. Prices below all three moving averages. So even if you mistakenly call this a trend, there's a nice little pullback. It's dropping like a brick. Target's down at 130. So if you said that it was hit, now here's the great thing. If you didn't see the consolidation, prices below all three moving averages, go short. Prices in a range, take the reversal off the range high. You're taking the same trade. The only difference is the location of the trade. So if you're not there yet with the more observational stuff of the recognize the consolidation, because sometimes they get overlooked. And interestingly, we've got this built into the tool here as well. How many crosses right there in the average price have there been in the last 100 days? Okay, so AMD, I mean, you could expect a consolidation on the daily charts. BBWI could expect it because there's a number there that says, hey, there's multiple crosses in the average price. Maybe there's a consolidation. Again, we need to visually inspect, but we're anticipating a consolidation. So if you want to trade consolidations, you can do. You can use the moving averages, a traditional trend trading tool, to find consolidations. Pretty cool. Trade the breakouts. I spent 12 years just trading breakouts and reversals. This pattern that we see on Apple, reversals and breakouts, absolutely fabulous. Google has got a good little breakout as well, actually. Let's check out that. So Google, there's the consolidation. Multiple crosses in the average price. Draw a big box around it. There's the breakouts. Bearish. We've got a target down to $90. I've been emailing you all, been emailing the crap out of all of you this past week about Google. So same trade, range reversal, down at the target, 105 range lows, breakouts, next target is the breakout target. Height of the consolidate, where do we get $90 from? Height of the consolidation, deduct it from the range low, that gives me $90. All right, Chris, thanks very much. Enjoy your meeting. Where's my thing? Let me just check the check. I don't see any questions. Right, let's throw things open and we just check the YouTubes. I'm not seeing anything there that I haven't already dealt with. Okay, cool. So let's throw the mics open. There we go. Let's throw the mics open. I think everyone gets this. Buy the dip, sell the rally, buy range lows, sell range highs, stick to 25 stocks, keep it consistent, and your universe is at least 25 opportunities, 25 stocks. If you want to trade it on the S&P, just trade one thing, trade the S&P. If you want to trade the currencies, trade the pound against the dollar. If you want, it works, but at the click of a button, we can validate the strategy and we can pick and choose the thing that is most relevant to your personal situation. I'm greedy. I like to trade lots of things. In fact, let me just give, before we actually go there, so if you've got a question, raise your hand and I'll open the mic. There should be a little hand button that you can raise your hand or just pop a comment in the chat box. So if you've got a view on the news or you've got a question, let me know and we'll get it. But it might be worth just finishing, because I have bounced around a little bit and the coffee kicked in and I was a little bit scatterbrained. Let's just more concisely go through the routine that I typically use. So this is my top 25 stocks. They're split off into bullish, bearish, and leave alone. And I've got a column here that allows me to say, is there anything that I may need to do immediately? So there's some numbers in this column. I'm not going to explain it because it takes a little bit, we're running out of time. We've only got a few minutes left and I want to try and at least be respectful and finish on time or close to it for a change. But I can go to that column, and on the bullish side, that's the only one I need to check today, because it's just flirting with the moving averages. So if I'm not in a trade right now on this stock, I am over here early, too early. But if I needed a new trade, when it goes back above all three moving averages, I can get positions, should I choose to. Now I'm already in this, so I don't need to, but I can, at the click of a button, say, hey, there's one thing that I need to check today on the bullish side. It's going to be CVX. Great, let's go and take a look at that. We just have, I'm already in it, so I don't need to take any action. So we've got 1, 2, 3, 4, 5 things that potentially I could take action on. 2 of those 5 things have a consolidation, or at least the average prices are flipping and a flopping. So when we look at BBWI, and I'm expecting to see a consolidation, now I'm looking at it, we've got 1 cross, 2 cross, 3 crosses in the last 100 days. That's what that number means over there. But visually, don't think it's in a consolidation. It's just because those crosses happened within that time horizon. If that 3rd cross was also at that same level, we'd be saying it is a consolidation. Let's call it consolidation. But as it is right now, a little bit of common sense. That's why it requires a little bit of a visual inspection. We've got the average prices crossed over. There's the 50, there's the 200. Prices just coming below the 50. Below the 200. So when we get below $35, I'm going to be bearish. So again, nothing for me to do today. So I'm going to move that into my action area. So Monday, that's probably going to be the first thing that I'm going to check for a brand new trade. So when prices below all 3 moving averages, go short. It's not there yet. It's close. So I'm going to move it to my staging area on Monday. That'll be the first thing that I will look at. And I'll probably have to place a trade on Monday. Let's check out ISRG. Again, I'm already in a trade on this, so I don't really need to take any action today. So again, in the interest of disclosure, I got the last one. Again, prices below all 3 moving averages right there. Previous trade was profitable. Take a new trade on almost just a few days later, have to sit through retracements. But as of right now, I'm already in the previous trade. I've got plenty of time on my clock, so I don't need to take it. However, as price is below all 3 moving averages, the algo has fired off. So if I needed a trade, there's a trade right there. Essentially, is price below all 3 moving averages? Yes, go short. In my case, I would buy puts. I've already got some exposure, so I don't need to initiate anything new. So I'm just going to leave it there for the moment. Jefferies Financial. Next on the dance card, Glenn, I've got your question. I'll see you. I'll answer that in a moment. I'll read it properly. Average prices are crossed over. Price is between all 3 moving averages, so wait for it to go below. So essentially below about $35. We're very close on Jefferies Financial. This is a great swing trade actually. So I'm just going to pop this up to JEF. Probably be the first thing that I'm going to check on Monday. Probably not going to see an entry today just because you know, the typical range of movement is not there. I'll probably check things in the last 30 minutes of the day. You know, we may see a runaway movements, but for right now, I don't need to take action. What else have we got? SLG, again, I've already got a trade on this, so I don't need to take action. We've commented on this. We have the breakouts. There's the breakouts. Sell the rally in a downtrend, so there's my entry. It's the same entry as earlier, but if you needed a brand new entry, we've just gone back below all 3 moving averages. Go short. Again, I'm already short here, so I don't need to do anything. And when I say short, I bought puts to express my bearish viewpoints. Amazon, how I love thee. It's been amazing. I've been trading this on the 60-minute charts. We've had multiple trades on the lower time frames. It is back below all 3 moving averages. I'm already short off the lower time frames, so that's that. Now, you should probably gather it takes a little bit longer to actually explain this than to actually do. When I'm doing this on my own, it's literally click, 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 move the 2 up to the staging area. That's going to be Monday's activity. Typically, then I'm going over to the 60-minute charts. I have a more active trade setup routine. So applying the same thing on AMD, on Apple, on Amazon, on Google. They're all running nicely. Unsurprisingly, I'm bearish in all 3. So there's no action for me to take. I'm just waiting for profit targets or trade management to be done. So from the 60-minute chart point of view, checking at the end of the day. And if there's anything to do, I will do it. But from a new trade point of view, it's already done. Again, day trade stuff. Again, I usually have a little look for some day trade stuff. I track 3 or 4 things. It's more the cherry on the top of the day. I've not seen anything that catches my attention from the setups that I like. And then the other thing, lastly, we've got the S&P 500 trade. The 1 trade a day setup. So the previous trade was there. Again, I posted this. So your risk profile is there. And we had a target opportunity down at 3,500. So yesterday's trade was pretty decent right there. The previous day, as I've already commented, it didn't really go very far, very fast. It was essentially, 6 points break-even trade, same setup on Thursday. Ran quite nicely. It was about 55, 56 points, just off the top of my head. We looked at that on the slide earlier. So for today, what do I need to happen for my 1 trade a day on the S&P? Again, price is below all three moving averages. Just bear with me, let's get that. So price is below all three moving averages. I need to sell the rally in a downtrend. So price needs to come back to either 3,900 or 3,950, or it's a little bit lower actually. The two, let me just tidy up. My apologies, folks, my apologies. Let's try that again. Right, price is below the 200, the 50, and the 20 there. So for a brand new trade, price needs to come up to either the 20 or the 50 period moving average to be thinking about a short trade. It's not there yet. It may get there later in the day. The way the day is rolling right now, it may not set up. So my one trade a day opportunity might not present itself because we're already moving in the trend anyway. I've already got the swing trade on, so I'm not missing out on the S&P. I'm just not getting my day trade version of the strategy. We come back to the S&P again. The actual S&P trade has fired off. The algo is there from the daily charts, so basically below about 39.80, initially targeting about 3,700, and then beyond once we get past that. So that, again, the points I'm getting to is that it's very time efficient. I know what I'm looking for. I'm just waiting to see has it there. There's two swing trades on the daily chart that I possibly need to take an action on Monday. I've already got a lot of exposure on the stocks already, so there's no action to take on certainly the top 25 that we just explored. The 60-minute swing charts are on and active, so just waiting for those to get going. The one trade a day on the S&P, probably not going to set up today, but the daily S&P is rocking and rolling. And if you want to place it with options, you can certainly trade it with SPY as an alternative. And again, that's already fired off and running lower, as we can see there. We've got a brand new trade that fired off pretty much last week. So it's time efficient. Again, when you know the rules and you know what you're looking for and you're just waiting for it to happen, you're basically like a farmer planting seeds, waiting for the crop to yield something. So you're going to have at least 25 stocks if you're following the small portfolio approach. If you've got the one trade a day on the S&P, you're just checking in quite literally once, twice a day. Is the trade there? Yes or no? If yes, place the trade. If no, which is where we're at today. If no, you know what? Come back on Monday. If not there at the market open, so we don't need to worry about it. The market's already in motion, so we're probably not going to get that brand new trade today. So come back on Monday. For the swing trade point of view, you need to check in 2-3 times a week. Trade's already on. There's no action for me to take, just waiting for the profit targets to be reached. So it's going to be a pretty quiet day for me today. The reality is that just reviewing the setups with minimal explanation, it's taken less than 5 minutes to go through. Does that make sense? It's taken less than 5 minutes. The point is that it's time efficient. As always, it takes longer to explain these things than to actually do them. But even when I am explaining to them, 20 minutes? What do you reckon? 20 minutes? Less than 20 minutes? Which means that I can put the trades on, do sessions like this, help other traders get a leg up on their own trading, and help you make some measure of success from the markets. What I'm planning on doing later, I've got a local band that I like. So I'm going to power down because clearly there's nothing for me to do other than to take that FedEx. What's FedEx doing? FedEx will be closed, FDX. FedEx is looking like it's going to be closed. Let's just check out where we're at. FedEx. Yes, there we go. So we've got a nice 183% return on capital. That's looking gorgeous. Thank you very much. We've gone from break even to a doubler. You can't complain about that. I'll have that every day, twice on Sundays. So I've got one thing to do, which is take profit. And Kevin, are you here? Kevin's gone from, now in my case, I've got about 100 days left on my trade. I think, Kevin, are you here, my friend? I think Kevin mentioned in our group, he's gone from, his expires today. So he's gone from, fourth, insert your own expletive, crying out loud. I'm going to have to take a max loss on this. To holy shit, I've got a doubler. I'll take that. It just continually proves why we can't. The trade's not over till the fat lady sings, or till expiration in this case. And I've seen this happen so many times over the years. In fact, I'm just going to take that FedEx trade. Just bear with me. Let me just get some chat boxes out the way. It's 5:80. Built. Love it. 180. So 183% return on capital. That's very nice. I'll take that. Thank you very much. But the profit target was a retest of the low just for reference. So I'm not going to say no to that whatsoever. I'm just going to mark that off. We're about there on the exits. Again, I like to visually mark everything off, so that's what we do. You can see all my past trades here. So again, I am a very visual trader, so this is just my OCD kicking in. There we go. So we got twice as much as what I originally wanted. As a nice little bonus. So again, I'm not going to be fair, Zeke, it's not a great trade. Again, I'm going to practice what I preach here. There's nothing to do with ego. I am going to shout it from the rooftops, don't get me wrong, but it's just from the point of view of, you know what, you just don't know. You don't know until the trades run to its conclusion. And it was a great trade, but it was nothing that I did. Nothing that I did. All I did was place the trades with the frequency that they set up when they were supposed to, exactly, traded the rules. I traded the setup with the frequency that it set up when I was supposed to take the trade. And this time it gave me twice as much as what I was expecting. And unexpectedly, I was going to take possibly the loss on this. I was just waiting for expiration to, you know, wash my hands of it. So you don't know until you know. And all that I do know is that on average, over multiple occurrences, it works. And there's the evidence. If I just buy the dips and sell the rallies on a portfolio of stocks and take the trades when I'm supposed to take them and manage the trades when I'm at the most opportune moment if they're underperforming and wait for targets if they are going, then I'm looking to emulate a positive expectancy strategy. That's all I'm trying to do. And for some reason, folks, it seems to be working. It's simple rules that make money consistently over and over again. And if you noticed, I'm not jumping around from market to market. I've got a 25 stock portfolio for the monthly and quarterly swing trades. I've got a 4 stock portfolio, which I will be expanding, a 4 stock portfolio for the get paid at the end of the week strategy. I've got a 1 instruments portfolio, the S&P, for my get paid daily. The only thing that I'm inconsistent with is the daily charts, the day trade at the open, because it requires about 90 minutes to 2 hours of my day if there's going to be a trade on. And I've got to admit, I'd rather be doing something else. So the only reason why I'm not doing it is I'd rather be doing something else. But if you've got more time, then you can do the day trade version, get paid at the open. There's plenty of opportunities every single day to get, you know, $1 or $2 move on, you know, 2-minute charts. Again, the sacrifice is time. I just don't want to sacrifice my time. I spent 12 years day trading, and it's not pleasant after 20 years. You know, certainly after 12 years, I was pulling my eyes out. I don't want to do it anymore. So it's just a personal preference. Practically, I could sit here all day, but I just don't want to do it. So the way I think about the day trade stuff is it's a bonus. So if I happen to be there and I've got a perfect setup, I will take it, but I'll know today if there's an opportunity tomorrow. And in fairness, there wasn't the perfect setup for me. I've already got the swing trades. I'm not missing the move. So I always think about it, it's like the cherry on the top. It's a bonus trade. And I'll get 1 or 2 a week in fairness. But I'm only planning on doing it if I know I'm going to be at the desk. So that's just kind of like my viewpoint, my philosophy. Where's my slide deck? Right, okay, so right, Glenn. So do I have a feeling where the market is generally headed for next in the next 6 months? Glenn, I don't care. I honestly don't care. If you can't gather, I'm going to profit from upward swings or downward swings in the markets. But yeah, I think you just picking up on the second comment there, it doesn't matter. I'm looking to benefit from up and down swings. I'm not an investor. I'm not looking for buy and hold. I'm not dollar cost averaging. I'm not doing any of that nonsense. I'm just looking to profit from the fluctuations in the market. And there's going to be some good times. There's going to be some bad times. Again, last month, as we mentioned, the market was in rally modes, in a huge bear market rally. And we were saying it's a bear market rally. There was no bullish stocks on the swing trade setting up. I've got to admit, it was painful. But right now, fast forward a couple of weeks, and within 7 to 10 days of the market coming back into alignment, it looks like we've got more of a two-sided market now. those bearish trades are really accelerating. I'm super happy I've filled my boots on the bear side. So I suppose the point is, it doesn't matter when you've got a daily swing trade strategy. There's going to be those lulls and lags, essentially compensating for the short-term bullish market movements or the rallies. Again, I've got the 60-minute charts to capture some of the faster swings in price. And again, if you want some really fast action, you can certainly do the one trade a day. I've got to admit that the S&P strategy, although it's newly rolled out and validated and back tested and forward tested, and there's a shitload of data to support the trading rules that we have, and there's a few extra conditions for the day trade strategy to make sure that it's mechanical and rule based. But that's the same strategy that I traded back in 2001. It's just that it's more refined and rule based. Whereas back then it was more seat of the pants, 3-minute charts. I've got to admit, I was jumping around from time frame to time frame, which is why I can speak from the position of authority that we shouldn't do it. It was 3, 5, and 7-minute charts, and I would just kind of jump around a little bit. So that was what I did do briefly, and then settled on, I think, a 5-minute chart. No, 3-minute charts. My apologies. But it's not a far cry from what I was doing back then, and it's just a variation of the same strategy. And all we're trying to do is capture the main move of the day on index futures. It works on the S&P, it works on the DAX for the moment if you're in the European time zone. And again, I'm constantly validating the variable rule set, because there's still rules, but there's some variables that we need to input and change and tweak. But the variable rule set is set in stone once we've validated them on the various markets. So there is quite literally something for everyone, regardless of your commitments and time experience. Oh, cheers, James, just catching on with the comments. Great session. Thank you very much. Anyone have anything to add? If you've got a view on the markets, happy to release the phone lines, or if you've got any final questions before we hang up. I'm just catching through the scroll. Mark, yeah, as long as the Fed continues to aggressively raise the rates, we can most likely remain bearish. Yeah, that's absolutely right. Again, the only reason why I know such things or hear about such things is because great people like you, Mark, tell me about that the Fed's doing this and the viewpoints and all that. I honestly go out of my way to not look at the news. I do try not to, but people keep me informed and they ask me my viewpoints on such things, and I've got to admit, I'm not interested. The way that this style of trading works is that you place the trade when you're supposed to trade it, and you have no opinion. And I've traded my opinion, and every time I've traded my opinion, I have been absolutely spanked by the markets, because at some point that opinion is wrong. So I would just rather trade with the data. Again, one more time, I would rather trade with the data. I find a great program who's validating everything. I am going algo nuts at the moment. I'm completely converted to rule-based decisions. Buy the dip, sell the rally. There's the proof. Should we trade the S&P 500 on this, buy the dip, sell the rallies? Yes, unquestionably. Should we trade Amazon? Unquestionably. Should we trade Pepsi-Cola? Pepsi-Cola, big multi-cap company, international, great product, good dividend. Actually, we probably shouldn't trade this strategy on Pepsi. It's not that we can't make it work. It's just that to make it work, I've got to apply discretion. Why should I bother? Let's go to a different stock or a different market or a different instrument. We've got thousands of stocks that we can trade that are validated with this style of trading, that are ideal for swing trading opportunities. Anyway, I think I've belabored the point, folks. I've belabored and labored, maybe over-labored, but nonetheless, I felt like it was a great session. Obviously, I'm a little bit hyper. I'm super excited today because it's just a good day's trading. What can I say? Patience is being paid. So as with all things, I'd just like to finish off by saying thank you. Thank you for your time. Thank you for your attention. The most precious thing that you can give anyone is your time. So thank you very much from the bottom of my heart for deciding to spend some of that with me here today. As I mentioned at the top of the hour, you can work more closely with me. It's an invitation. There's no hard pitch, no hard sell. I give as much away as I can on these open sessions. But if you want to know the specifics, the rules, the tools, if you want the software to assist you like you've seen, me use. If you want the specifics of the money management, because again, I don't have time to do it in these sessions, then you can work with me. It is an application. I don't work with everyone. If you're looking to get rich quick, I am not for you. If you want to get wealthy slowly, then this may be right for you. But let's have a conversation first. And just keep in mind, if you don't change anything, if you change nothing, nothing will change. And you've always got two choices. You can keep on doing it the way that you're doing it and getting the results that you've always got. Or you can press the easy button and plug into a tried and tested system that is proven. I've spent thousands coding this bad boy up, and I'll continue to improve it and make it better. We've got a family of systems that work. Most importantly, it's replicatable because you tell me it is. We've got great success stories in bullish and bearish markets, and the results obviously speak for themselves. Right, folks, let's do it. More importantly, you do it. If you take something away from it, if you've had your aha, if you've got your epiphany, go and put it into action. A lot of people get enough from these sessions to go and do it. I had another lovely gentleman that I worked with many years ago, circa 2004, when I used to do a Forex trading room. And when I was just looking at those markets, and he sent me that, he sent me a lovely note saying, "You're my first mentor. And I just want to thank you for laying the foundation for him becoming a trader." And fast forwarding, almost 20 years now, he's now become a funded trader for a prop shop based on the strategies and systems that we use today, but I first taught him 18 years ago. So I'm very pleased by this. It is possible to make a career of these things. And if you just want to, make some retirement money, or, have some pocket change, or, do other things, it's a second income or a side income. And for me, it's, my full-time gig, just put it into practice. Again, we know it works. Right, with that said, let's do it. Game over. If you've got any questions, if I've missed your question, shoot me a message. Best place to get to me is via Slack. I am mostly active there. I've got a nice little public community and a private community where we can all get involved. Lots of people just send me direct messages. So if I have missed your question, it's nothing personal, unless of course it is, in which case you'll never know. But just send me a message and I will get to it. Or you can just simply hit reply on any of the emails that you receive from me. With that said, let's do it. Awesome, David. Sound and discipline. Thank you very much for your kind words, David. Hopefully you've got something from it, as always. And what I've just mentioned is I would just hope that you put it into action. Right, let's do it, folks. Thank you very much for your time and attention. Let's dock the boats and let's go and enjoy ourselves. May your future hold ice cream. And if you're lucky enough, maybe even a single malt whiskey in your future. I know mine will. Have a great time. Have a great day. Enjoy your weekend. And I'll see you at the same time, same place next week.